Corporate finance practice problem using Excel. Land and 5-year MACRS depreciation, cash flow, and net present value problem. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information left-hand side, we're going to be populating that into the blue area on the right-hand side, putting together some of the stuff that we did in prior practice problems into a comprehensive practice problem. We're going to be putting down a down payment once again, expecting future returns in terms of cash flow, wanting to project out what we think will happen to see whether or not we want to actually put into place this plan. We've made some more little adjustments, added a little bit more complexity here. So we have the investment. We're saying it's going to be an investment in land and equipment. We have the 5-year MACRS asset. That's going to be the kind of equipment component of the initial investment. It then is going to have depreciation related to it, which is going to have a tax impact that we're going to have to be taking into consideration. The residual value of the land at the end of the project is going to be the $50,000. So we're going to assume the land portion that we sell and we're going to get back our $50,000 basically at the end of that. That means we're going to have a cash flow for it at the end of the project. We're going to say that we have a security deposit we're going to have to put in place for working capital that we're going to have to put down at the beginning as well. For the $54,000, we expect to receive it at the end of the project, receive at least 34 of that back, hopefully, at the end of the project. In order to do this, we're going to hopefully receive cash flows for the next 6 years, looking something like this: X1, X2, X3, X4, X5, X6 years out, 100, 230, 120, 90, 60, 40. Tax rate, we're saying, is 25%, and the cost of capital, our required rate of return, in other words, 12%. Okay, so let's first talk about the depreciation, because we have to think about the depreciation, not because it has a cash impact, even though we want to think about this on a cash basis, but because there's going to be a tax impact related to the depreciation. Therefore, we're looking at tax depreciation so we can figure out the tax impact related to the cash flows for it. So we're going to do the MACRS depreciation. Remember, in practice, you have to project out in the future if Congress is going to do any changes or anything like that, if there's a special depreciation, 1 year, first year deductions, and all that kind of stuff. But just in general, we have the MACRS depreciation that we're going to be applying for the amount that is going to be applicable. It will be determined on the type of asset that we have as to what kind of depreciation options we need to be putting in place. Land, you'll see, normally typically isn't depreciated, so we don't have to worry about it with regards to land. So you could look at publication 946, which you could find on the IRS website, irs.gov, and look at the whole thing for different components with relation to depreciation. We also have a schedule on table A1 related to the percentages for the half-year convention, so you can take a look at those as well. But we're going to go ahead and kind of estimate the calculation for it so we get a better idea of what MACRS is kind of doing, how it relates to straight line depreciation. So let's do that first. So we're going to say the cost then of this depreciable part of the stuff we're doing here is that $300,000. So the $300,000, and I'm going to say the number of years that it's going to be depreciated is 5 year. It's a 5-year life thing. So font group underline, and then we're going to say if it was straight line, which it's not because it's MACRS, double declining half-year convention generally. But if it was straight line, 300,000 divided by 5 would be about 60,000. If we compare that then to the cost, comparing it to the cost of 300,000 to get the percent of the straight line percentage, the straight line percentage, the SL percent, would then be the 60,000 divided by the 300,000. Let's make that a percent. Percentifying it, 20%. You can also get that by saying equals 1 divided by the number of years, 5. Also getting the 20%. So we need to double that. So I'm going to say times 2. Why? Because it's basically a double D, double declining type of method here, even though it's double declining half-year MACRS funny tax double declining. It's basically a funny tax double declining method called MACRS. So we'll take the 20% times 2. We would then get to the 40%. So now we got the 40%, and that's the double declining rate. The double D rate, I already put that there. And then we're going to multiply that times the cost. So times the cost, which is the 300,000 we're saying, underline that, font group and underline. That's going to be the double D Depre for 1 year. Double D Depre for year 1 would be 120, but then there's the half-year convention, meaning we assume no matter when we bought it in the year, we bought it in the middle of the year, so we have 6 months of depreciation. Underlining that, then that's going to give us our MACRS depreciation for year numero uno, 120 divided by 2. So that's the same as what we would have got with the straight line, but it's not straight line. It's MACRS double declining half-year convention. That's important, so because in year 2, you can't do the straight line thing or it'll be wrong. So we're going to take then 40% again, 40% times like the book value on a tax basis, meaning the $300,000 cost minus the depreciation that has gone thus far. Underlining that, we're going to multiply that out. We got the 40 times the 240, and there's no half-year convention here, so we're just going to move on. 40% times basically the book value on a tax basis, meaning the last kind of book value minus the 96 that we took last time, making this a percent up top, underlining the 144 multiplication. The 40 times here, we're going to say, all right, there's the 57. The 57, okay, that's going to be pulled down. And then we'll do it again. Let's do it again. Why? Because it's fun to do it. And so we just keep doing it. And then we're going to percentify this. This is going to be where we were last time, minus last time's depreciation. So multiplying this out. Underline, font group, and underlining. So now we're at the 34,560. Now on the last two, they do something a little bit different. So we'll kind of mirror the tax code. You could do the same process one more time and then have the plug at the end. That's basic double declining. But you can see they kind of mirror the rate here at the end. They kind of standardize it. So once again, MACRS is a little bit weird. It's tax code. It's going to basically be double declining half year, but a little funny. So I'm going to mirror that a little bit more closely by doing the same process for the last two here, or deviating a little bit. I'm going to say the 86.4 minus the 34,560, and this I'm just going to pick up the same amount, the 34,560, and so there we have that. And then pulling that down, here we have it. Let's underline it, and then we have what we need left. This minus this is what we have left, and that's going to be the last year, so we're gonna have to get back to 0, so that's going to be what we pick up then, and there we have it. So there we have it. So if we add all these up, they add up to then the 300,000. Again, you might just do that more easily by picking up the information from the tables using those percentages from the cost, but I think it's useful just to see where it lines up with the double declining balance to some degree, to see what's actually happening in relation to depreciation related to basically straight line. Okay, so now we can take that information, we can do our cash flow so that we can take into consideration the tax impact. We'll do this a bit more quickly using some copying and pasting to put this in a little bit faster. So we're going to say the 100,000 is the 100,000 income we're going to get over here. I'm going to say tab plus year 2, the 230 tab plus year 3. Year 3 is the 120 tab plus year 4, 90 tab plus year 5. Year 5 is going to be the 60 tab, and then plus finally year number 6 is the 40 and enter. So there's our income. Let's pick up our depreciation, which we just calculated now, so that we can then take the tax impact on the depreciation, which is going to be what we just calculated here. So we're going to pick up that 60, enter. Going to say Control C, copy, right arrow, holding shift down, right, and then Control V, pasting it down, paste it down. And then we'll underline, home font underline, and that's going to give us our earning before taxes. Earnings before taxes equals the 100 minus the 60. Copying that, Control C, right arrow, holding down shift, right, Control V, paste. Then taxes. Taxes calculated at the 40,000 times the tax rate, which we find all the way to the left, all the way down. That's the 35%. Going to make that an absolute reference, selecting F4 on the keyboard, putting a $sign before the B and 23 so I can copy it across. That's typically what happens when you're doing to something outside the table, often from the data group, because then I can copy it and paste it right here. Control V, paste that down, paste it down. And then we'll underline these ones, go into the font group and the underline. And that's going to give us then our earnings after taxes, which will be equal to the 40 minus the 14. Copying that 26, right arrow, holding down shift, right, and control V. So then we're going to have to add back our depreciation now that we figured out the taxes, because depreciation is not a tax thing. We actually paid for this all in year one. We only had to deal with the depreciation for taxes, because taxes greatly complicate things. But that's why Congress does it, to keep us accountants and lawyers in business. They work for us. They work for us here just to keep us busy and keep us making money. So we're then going to say that we have the sale of the asset at the project end. These are those kind of special things that we said we had at the end, where we sold the land when we don't need it anymore. So we're going to assume we get it back at basically the cost. So I'm not going to calculate the tax impact on that, because we're saying we sold it for what we purchased it for, basically. So cash inflow back in $50,000. And then we're also going to say we receive part of that deposit coming back in as well at the end of the project. So we'll say that's coming back at, we're saying of that 54, we're getting 34 back. So you can imagine many different scenarios where you can see the cash flow changing up for many different things. You can have a long-term projections out, budgets that would go out, and as long as you're applying out the cash flows you believe to be happening, then we can present value them. Remember that as you do that, though, we're kind of assuming everything happens at the end of the year, at the end of each year, instead of throughout the year, because that's a limitation of our present value calculations. So then we're going to go ahead and underline that, and that's going to be our cash flow. The flow of cash is going to be equal to the SUM of these three. We're going to copy that, Control C, and paste it down. Paste down. Hold on a second. That's not quite right. I'm going to delete that. It's going to be equals the sum of these three, picking up the earnings after taxes, and then the depreciation, and then anything that's going to happen down here. Notice that nothing's happening down here, but I'm still summing up the entire column so I can standardize it across. So then I'm going to autofill it across. And so now I can have a uniform, calculation all the way across. Let's put the double underlines down here. Font group, double underline, W, double underline. It's not a double U, but a double U. It's a U, that's not a W. Anyway, so then we're going to say now we can do the net present value calculation, which we can then tack on down here, or we can do in our table to the right. So let's tack it on down below, so we can see it in both of its formats, the horizontal and vertical fashion. So we're going to call this cash flow. I don't know why this is going to be, I see what happened. Let's put cash flow up here, and then cash flow. So notice I'm naming the cells 1, 2, 3, 4 by the year, so that I can use them in my cell references and copy the reference across. So we're then going to say this will be equal to the 86. I'm just going to copy that across, just bringing those on down. And then we got the present value. We'll just do our present value calculations from year to year now. Bringing this one back to year 0, negative, PV, shift 9, rate, all the way to the left. We're picking up the rate. This is going to be our discount rate. Might be called cost of capital. Might be called required rate of return. Might be called the hurdle rate. It includes what we want in terms of our gain. Therefore, if the net present value is anything above 0, it's something we might pick up. I'm going to then hit F4 on the keyboard, making it absolute, so I can copy that across, as is typically the case for anything that's outside of our table. Comma, number of periods is going to be that 1. Notice I have it up here, and instead of typing it in or hard coding it, in other words, same thing, typing it or hard coding it, same thing, so that then that will change as we copy the formula across. Comma, because it's not an annuity but present value of 1, and then we'll pick up the amount, which is right above here in M13, which is the 86,000. Now I'm just going to copy that across. I'm going to put my cursor on it, copy that across, and then I'll double click on some of these to make sure it picked up what we think it should. You could do that by double clicking, and you could see it here, what it's been picking up. If you want to know where something else is that's further away, you might use this tool over here, which is in the data group. I put it in my shortcuts up there, so that's where it always is. It's in formulas, the formula auditing, so you can trace. So I could say, okay, is that picking up the right rate? Come on over here. Yeah, there it is. That 12% is going in there somehow. So it looks right. I could double click here. Looks like it's doing what we expect it to do. Right? Looks correct. So it looks good. I'm satisfied with it so far. So then I'm going to say sum up this way. Sum it up on the left hand side. And then we'll add to that the investment. The initial investment all the way over here is the negative. And there's a couple things we had to put in. We put in that full 350, which we're saying we broke out between the 300 and the 50 here. And we put in the security deposit up front that we got part of it back. This cash, the working capital we had to put in. So we had to put that in. Those are the initial investments. And we got some of them back at the end, right? But we already accounted for that. This is the initial money we put down, some of which we might have gotten back later. So there it is. We had to put that down at the beginning. The 404, that gives us the net present value calculation. Summing this up equals the SU to the M. SU to the M, we get the 21,272. I'm going to put an underline here, font group and underline. So there we have it. It's above zero. Therefore, it's a job that we might pick up because it did clear then the required rate of return or cost of capital, which we said was, what was it again? 12%. So let's do that same calculation in a vertical fashion here, which is more than what we've seen in our beginning problems. So let's do that this way by going 0, 1, 2, buckle the shoe. All right, I couldn't help saying that because it rhymes. Then I'm going to copy that down, and then we're going to go to the alignment and center, and then we'll say total. And the 0, we're going to be picking up that 404. Let's just pick it up down here. Then the cash flows, I'll just have to pick these up. It'll take a little bit. Cash flow was the 86 for year 1, enter. And then in year 2, it was 183.1. And then in year 3, it was 98,160. And then in year 4, 75,65.96. And then in year 5, 51.96, and then finally in year 6, 116,048. Summing that up equals SU to the M, shift 9, up arrow, holding down shift, up, 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 up. And there we got. So if we didn't have any present values after the 6 years, we're looking flow of 201, but we need to present value it at the discount rate, cost of capital 12%, negative. PV, shift 9, rate all the way to the left, picking up the 12%. There's the 12%. Going to select F4, keyboard, $ before the B and the 25, comma, number of periods 0, comma, comma, because it's not an annuity but present value of 1, picking up the 404. It's going to be the same number if we did it right because it's still at time period 0, but we can then copy it down because we did it properly here to be able to copy it. So then let's go put our cursor on the fill handle, drag that fill handle down, double click somewhere down here to see if it does what we expect. That's still an absolute reference. Everything looks good. Is it picking up that one thing, that cost of capital way over there? Let's just check it out with our little arrow key. Arrow key, is that, yeah, there's the cell. That's the cell that should be there. So it looks good. Looks good. Looks more than good. It looks excellent. Closing this back out, underline here, summing it up equals the SU to the M, shift 9, up arrow, holding down shift, up, 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 enter. And we get to the 21,207. So once again, it's over the cost of capital. Let's figure out what the IRR is. What's the actual internal rate of return? Using our formula, we can just say equals IRR, shift 9, and then just pick up this series of payments, the negative number, the outflow, positive number, inflows, make it a percent number group, percentify it, add a couple decimals. So we're actually at the 13.98 required rate of return here, which clears the 12%, I think is what the one we were looking at over there. So there it is. Let's make that look fancy. There, that's not right. Can't see that. You can't see that. There it is. Let's put a bolt thing around the side of it. So there's the 13.982.